Alright, I think we're recording now, so that's cool. I don't know where my fucking records go. Either way, so there's something I was thinking about. I was thinking about the logic of how the stock market actually works, and I think this makes a lot of sense. Now, let me open up SPY just to make this point a little stronger. So basically, the stock market should be going up when there is general progress, right? So if, for example, if you start a business and you're selling like lemonade or whatever, this is in a Vox video, and I thought it helped me kind of realize this thought. It's if you're selling lemonade and you want to grow, so you IPO and stuff like that, and so people start buying and selling your company shares, all this buying and selling is based on it's all speculation.
Yeah.
None of it is like actual, and that makes sense, right?
Yeah.
We already understand that, but speculation means that every time there's a trade, and this is kind of like a virus actually, every time there's a trade, there's an evolution to that stock. Now it is expected to do better than it was doing.
Mm-hmm.
Right? So, but for you to do better, the company has to do better. The company needs to be making more and more and more every single time the stock is traded, essentially. Mm-hmm. Right? For it to be considered that it will be worth more. And this is all included in the idea that we have a economy as well, and the economy kind of plays its parts and stuff like that. But here's the thing. Stocks, in reality, like in the absolute most long term, will either go up or down. Right?
Okay, yeah.
And that makes sense. So in any case, wouldn't it have made, just back with Tesla, for example, like a while ago, it would have made sense to do one of two things. And we also saw this with Beyond, right? You either long it and short it out for like a month. So just buy, what about leaps for everything? Every single stock, you buy leaps. Both directions.
Okay.
And then and whichever one, you can use your fundamentals to kind of figure it, because more often than not, everything is moving somewhere, and so you kind of pick a direction, right? And this is more. I think it makes a lot more sense in my head, and I'm trying to figure out how to kind of properly come up with the words to explain this.
Okay.
But if you were to, at this point right here, if you were to buy leaps for, let's say 150 calls or puts. And then, fucking, that's way too high. 400 calls, right?
Yeah.
At this point, while a lot of them haven't existed yet at this point, because they don't naturally believe that the price can hit that high, going in these positions means you're basically just betting on the stock market doing what it's going to do. And
so why wouldn't it be a smarter choice to just buy the stock itself?
Well, that's
for the upside, and then
we can't, right? When you're dealing with small accounts, you can't do that. But
but the premium for 5-6 months out.
But spreads on them isn't.
Still pretty costly. Actually, yeah, no.
No, I don't. I think once it beats.
But the spreads are usually, if you go that far out, they're at least $10. They're not like the $2.50 range that we're.
They're like 1,000.
Yeah, they're like $10.
But what can they hit?
And so the max gain on that is 1,000, right?
Yeah.
But you'd be spending about 200, 400, things like that.
But moving over that long term, as far as a long term investment goes, getting 500% is a very, very good thing. Right? For example, like there's a shit ton of capital that's unused in this account. There's a shit ton of capital in all of our accounts that are practically fully unused. Mm-hmm. Now, I'm not saying spend it all. I'm just saying you have to think in forms of growth, and you have to think in terms of short-term adage, right? So what we're doing when we day trade is we're adding stuff. But in the long term, there also has to be some sort of strategy where, and maybe this is more of an idea in the future when we do actually start getting into stock, more than options and derivatives and stuff like that.
Yeah.
That's definitely a way to think about it.
Yeah, I mean, because think about it. Like,
because it's either going up or down.
What people are already doing.
Yeah.
Because they're buying, so if you do have money, they're just buying the stock, waiting for it to go up, and then what are they doing? They're buying puts.
Yeah, they're hedging.
Because either way, it's going to go either all the way up or all the way down.
Yeah.
And so in that way, they're accounting for both sides.
This is true.
Yeah.
But they'll lose on the puts, so they got to make sure their puts don't actually counter their profits, and that's another way to think about this. And it's just a thought that I had. I was just thinking that if a company is not making progress, then it's just going to be going down, because no one is going to pay more for it, and people don't want to hold on to something that becomes harder to sell, and as a result, they go down. I mean, a perfect example is J.C. Penney. Not KCP. Right? J.C. Penney is like off the NASDAQ now.
Mm-hmm.
But like they stopped doing innovative stuff for a long time, and then as a result they just kind of kept going. And if you were to buy timed positions on these, you could make a ton of money following basic market trends. I mean, this is a very basic concept. Right? Tesla, after they beat their earnings, this is not Tesla, by the way. Tesla, this is a new company, you can tell. After they beat their earnings in this one, it was very fucking easy. By the way, they have earnings tomorrow. We should
No, today, after March.
You want to play it? They're probably
They're
so expensive.
Yeah, it's 4K for the monies.
Really?
Yeah.
Jesus.
Or no, at the money.
At the money?
Yeah.
Fuck, that's a lot.
Yeah.
4K?
Yeah.
Hold on, I need to see this.
You're on it.
Yeah, I am. I'm already scared because I'm out of numbers. Yeah,
3.
Jesus Christ.
Yeah, literally yesterday, day before. That
yeah,
much.
okay, whatever. Shut
So
the fuck up.
a spread is just still. Wait, so I mean, technically you can figure out the overall
Continuation.
expiry. What's the expectation though?
Oh,
you
based on
subtract the.
So the yeah, what?
Yeah, go on.
No, tell us that.
No, like from the price itself. If you have a 2.8K at the money strikes,
Yeah.
what do? Do you like subtract it and then you find that's how many dollars that it's supposed to move from
Yeah, you could.
575, I
think-
guess.
Let me think. Because the IV for these are 142, right?
Okay.
And so, to figure out the expected move, what you actually have to be looking at is, Tasty has that roll thing. Has a circle chart or whatever. I forgot what it is. Let me open it. I'll open it here. Tasty.
Oh, you can access it online?
Yeah, it's online.
Oh, nice.
No, it's called the ball. The wheel, yeah.
Wheel of Fortune?
I might have to open it on my own laptop because I'm not logged into a Tastyworks account here. Oh, we could just open it. I mean, might as well. Right? Okay, let me log in. Can you relax, Mr. Computer? Holy shit. Anyway, I mean, but either way, this is just the idea is that you take into long-term thinking of how these stocks move. I mean, because when you buy spreads, you're basically investing in the stock for less money, right?
Mm-hmm.
You're trying to get the same amount of move that you're like. So if it goes from here, so if you buy for 365 and you sell for 400 or whatever, then you're getting $35 out of it, and that is what you get with the options with less money. You get the same exact thing. You're not in stock, but you're using the stock, but you get more percentage out of it, which is why sometimes it can prove to be a little bit more fruitful. But yeah. What's my fucking email?
Boom, boom, boom.
What did I just quote?
950.
750.
1050.
Don't remember the login actually. Let me see if I can find it. But either way, yeah, this has been a brief recording. Thank you guys for watching.
Love you.
We're just doing this in the middle of our trade. That's why it's this way. Yeah, we love you. Whatever.